Hello everyone, welcome back to the macro world. In today's video, we are going to skip the charting part for now. We're going to skip all of this good information that I put together for you, and we're going to jump straight into earnings because earnings are only 3 days out for Netflix, and we need to know what to look out for, what to watch for to understand where the stock is headed in the next few months and next year or two. So with that being said, let's get started. The first thing we need to look out for is the engagement report. This is the entire debate because if viewing hours stabilize, the bear case loses its teeth. The reason they're saying that is because the market thinks that the viewing hours are going down, and if people are not addicted to Netflix or if they're not spending too much time on it and the watch time is going down, that means that in the future they cannot do subscription cost hikes. And if that is true, then this cheap looking stock at $75 might just be at the fair value price right now. The next thing is the revenue versus the $12.57 billion guide. Q2 was guided as the content cost peak, which means that they're expecting this to be their most costliest quarter. And a beat here will reset the entire margin narrative, because if they can beat revenue in their most expensive quarter, that means that profits can keep expanding further on. And if they miss by any chance, that probably means that the growth is slowing down right now. The third thing to watch out for is ad revenue pace towards 3 billion. The second growth engine. The first one is the subscription engine, obviously. The second one is the ad revenue. 4,000 plus advertisers right now, 70% year over year. Is doubling that number on schedule or not? Because that is what Netflix said that they will do this year. They promised to double this number, and this quarter will show that if we are headed in the right direction or not. The good thing about ad revenue is that it is a pure profit engine. There's no extra content that needs to be created to take advantage of this. And lastly, Netflix is exploring live channels and bundling. Now, the market is questioning if this is an offensive move or a defensive one, because if this is an offensive move, they are trying to expand further on. That might be a good thing, but if it is a defensive move where demand is not holding your attention anymore, this is where this becomes a problem. So in the guidance call, we need to listen to that very, very carefully and see how they word it, because the market will react to it. Now that we've gotten that out of the way, let's go back to the top and let's get through this one by one. But before that, let's also discuss the chart. The first thing I notice on this chart is that from 2022 bottom, Netflix has made a move of about 700+%. This shows me that the stock needs a few months to just consolidate and go sideways. We do also need a proper pullback because all those buyers who have been holding Netflix stock are exiting. Either they exited on the top or they might be exiting right now. And this is where consolidation happens and old buyers exit and new buyers come in, and then market figures out what the right price is for the stock. And we're kind of exploring that zone right now. The first thing I notice here when I'm doing technical charting is that we had this previous high. The second thing I'm noticing is that the 200 weekly moving average is also coming in right below it. So as far as support goes, this stock is sitting at a pretty good place. So we got the previous high that we're retesting. We got the 200 weekly moving average that we're coming close to. And lastly, my favorite, which I think will be very helpful here, is that we got this level that tried to bounce a few months ago and we swept that low. And this is where liquidity gets flushed out. Notice we also printed this amazing bullish green candle. And if we can hold this area between the bottom of this candle and the highs of this candle, consolidate here and then push back up, I think on the short term, we do have a chance of this push up higher. Now, I don't know how high it goes. Maybe we jump here and then come back down again and retest a previous level. But for now, this is looking good. We got three confluences. We got the liquidity sweep of the previous level. We got the 200 weekly moving average coming in. We got the previous resistance level, swing high level, which might become support here. So when earnings come in, it can always go either way. It's a gamble. But after earnings, if the stock is still somewhere around here, I think we might have a good chance of pushing back up. Personally, this is not the stock I would touch. This is not my type of play. And I will discuss that in the next part of this video, which is going through the fundamentals that I've drawn out for you on Claude. I think Netflix got a lot of time before it needs to make a decision on what direction to move towards. And I got a lot of other better quality stocks that I can go long on. So if you're looking to add or you're already invested, next part is for you. Let's get started on the fundamental side. Why is the stock down to 42%? Let's go through the bear arguments and let's go through the bullish arguments as well. The first thing is the engagement that is slipping. Reports are showing that we're losing 30 to 70% of viewers by later seasons, not the start. The second season problem hit the tape in July, which means that people are watching the start of the first seasons. Even if they make it through the first season, people are not watching the second season when it comes out. I personally remember watching the 8-episode season, which I thought was genius of Netflix. They could have consolidated those 8 episodes into 1.5 hour movie and we would still get the same message. So anytime I see an 8-episode season anymore, I don't even watch it. I don't touch it because I know it's a waste of time. The growth hangover is the next part. Paid sharing plus price hike boost are fading. Q2 guidance on revenue, EPS, and margin, they were all missed. I like the sound of triple beat, but definitely don't like the sound of triple miss. The next thing is the defensive pivot, which I just discussed on what to look out for on the earnings call, is that nobody knows if the live TV channels plus bundles is a defensive or an offensive move. Only time will tell, right? But we do want to hear them talk about it on the call and see what they say. And lastly, the street is trimming into the print. Now, I do believe sometimes that these people are just scammers. They want some cheap prices, so they just cut price targets. And every time the stock is up, the price targets keep going higher. Every time the stock is down, the price targets keep going lower. And I don't really believe in these, but I just wanted to put this out there that Bernstein and Citi both have cut price targets here, and they did it right before the earnings, which is not a good thing. So what is working for Netflix? Let's talk about the bullish argument, right? Revenue is up 16% in Q1. The ads are roughly doubling to $3 billion. Margins are still expanding, which is a really good thing. Q1 operating margin was 32.5%. Full year target, we were looking at 31.5 versus 29.5 in 2025. And in 2024, 26.7. So you can see the a clear trend going upwards here. The next thing is free cash flow, which is up 91%. The forward year guidance was raised to 12.5 billion, and that is a really good thing. I think between the margins and the free cash flow, I like the story on Netflix personally. And lastly, the company believes in their own mission as well. $25 billion worth of buybacks and a clean balance sheet. That shows that they believe in what they're doing, and that is a total of 8% of their market cap right now, roughly. So looking at this, what I understand is that this is a good reason to hold the stock for the long run and expect that we go back to all-time highs. But this does make sense to why the stock is down 40% in the short term. You see, in investing, there's no right or wrong. You live in this gray area where you run this mental algorithm of taking the bullish news and taking the bearish news and putting a good case scenario together, and then you overlap it with the technicals to understand where you can get the best possible entry. Because even with the best possible entry, things can fall off and you could lose 20-30% of your money. So I use the fundamentals to create this display where you can see if the stock is cheap or overvalued. And right now we are sitting at modestly cheap. I personally still don't like this price, but if you are somebody who wants to hold Netflix for a long time, this might be a good place to enter. And if you overlap those 3 confluences that I mentioned on the technical chart, it kind of makes sense and the story aligns for you. But here is the most important part. How long do you need to hold this for? So I created this another data set where I can go through the possible valuations of the stock from 2028 to 2030. So about 1.5 years from now and then 3.5 years from now. So you can understand if your ROI is worth holding you this stock for that long. So in a bull case scenario, I'm looking at a 126 to 135 price range by 2028. And by 2030, we're looking at 187 to about $200. In a base case scenario, which is usually a good measure when you're investing, so you're just a little bit more careful, we're looking at $98 to 106 by 2028 and 135 to 145 by 2030. And in a bear case scenario, we're looking at 63 to 71. And personally, I will be interested if the stock price bleeds into the 60s for Netflix within the next few months, but I'll still need to see the earnings to make that decision. And by 2030, you're sitting at $77 to $86. and we are literally at that price point right now. So it's up to you to decide if this is the right stock for you to invest in. And my personal final verdict is that if I overlap these scenarios on the chart, including the confluences that I mentioned, the stock is a pretty good buy in my opinion, but it is just not for me. I like to buy oversold, overreacted positions. Two of my plays right now are Lulu and Adobe, and both of them look like dead cat bounces. And I'm okay investing into stocks like that. And with that being said, I hope you found value in this video. Please like, subscribe to the channel, and leave a comment if you choose to. And I'll catch you on the next one. Thank you for watching.